Hi, my name is Matthew Borson, and I'm the managing partner at Straight Path Wealth Management. And today I want to talk to you about a difficult life change that some of you may be going through. That's a life change of divorce. And when divorce happens, it creates a lot of financial changes. A lot of financial decisions need to be made. And so I want to walk through some of those today, give you a little bit of a guidance, and also encourage you to talk to a financial planner who understands some of these issues, because good decision making during this time frame is really, really important, despite it being also a very emotional time. So first, let's talk about dividing assets. And dividing assets varies greatly depending on which state you're in. So you could be in an equitable distribution state, or you could be in a community property state. There's more equitable than there is community property, but community property is pretty straightforward. The state looks at any assets or any debts that you've accumulated during your marriage as jointly owned assets that get split 50-50. It's pretty mathematical, there's not a lot of variation. However, most states fall under the equitable category, and there is a lot of variation in equitable. Depends on the judge that you have, depends on a lot of other circumstances. So making sure that you have a good attorney to walk you through this process will be really key, especially during an equitable distribution state like most are. There's certain things called marital assets versus separate assets too. Marital assets, again, this depends on states, but marital assets are things that you developed or accrued together, whereas separate assets are going to be assets that maybe you brought into the marriage, or maybe that you're going to inherit or did inherit during your marriage separately. Those things are treated separately too, so making sure that you have a clear listing of what those are, correctly categorized, will be really important. Separating debts is also a tricky issue when you're going through divorce. Making sure that you have a full listing of your debt and going and pulling things like your credit report, so that maybe there's some debt out there that you forget about, making sure that you have a full listing so you understand who's getting the assets and then who's being responsible for the debt attributable to those is a really important thing. One of the areas though that we help clients with the most is the tax implications of divorce. And there's a lot of different tax implications. The first is tax status. And from the IRS's perspective, they look at, are you divorced or are you married on December 31st? So basically the last day of the year. If you're divorced, then you do not file married filing jointly anymore. Instead, you file single or maybe head of household. However, if you're going through the divorce process, but it's not finalized yet on December 31st, you'll still file married filing jointly. But if the divorce is already finalized, most people will file single, or you have the opportunity to potentially qualify for head of household filing status. Head of household filing status is a little bit better than single because single has a lower standard deduction than married filing jointly, has lower tax brackets, and the phase outs for some credits are many times cut in half. Head of household is a little bit of a combo or a little bit of an average in between single and married filing jointly, where you get higher standard deductions, higher tax brackets, and some of the phase outs are a little bit higher too. But in order to be able to qualify for head of household, you've got to have a dependent. So you've got to have custody of a child that you get to claim on your tax return, and you've got to fund the vast majority of household expenses. And so there's some qualifications and some additional questions that us or your tax preparer may have to ask you. But if you can qualify for head of household status versus single, that could dramatically lower your taxes. And that goes right into the child custody issue. So child custody and who gets to claim the children on the tax return may not seem like an important question while you're going through divorce proceedings, but can have a dramatic impact on your taxes. Not only can that impact your status, but it can also impact things like the child tax credit. And depending on the age of your child, a child tax credit could be up to $2,000 per child. So if you are able to claim those children on your tax return, that could be a tax benefit of up to $2,000 a year. That's a pretty big difference. That makes it worth talking about those things, being very specific and planning around those. One of the other issues we get asked quite often about is alimony and child support. And alimony and child support are kind of unique issues, and there's actually been some changes on these over the last several years, that now alimony and child support are now essentially disregarded from a tax perspective. The person who is paying out alimony and child support no longer gets to deduct them from their taxes. However, the person receiving them also doesn't have to claim them as taxes, so they're just literally ignored or disregarded. This is important to think about because if you're someone who's receiving them, you don't have to worry about paying taxes or what the tax implications could be of either of those things. However, if you're the person who's paying them out, this is also important to pay attention to because you're still paying taxes on those. And so your after-tax take-home discretionary spending income may drop by more than you think it is because you're paying a net amount out to your ex-spouse, but still paying the taxes on that. So making sure that you correctly take that into account, making sure that you pay attention to that is really important. The last thing that I want to talk to you about is retirement investment accounts and how those are split, because there is some hoops that you've got to jump through. First, if you have a 401k plan or a 403b plan, so those are through an employer, you're typically going to have to get what we call a QRDO, or Qualified Domestic Relations Order, QDRO. A QRDO is a court-mandated order that allows your 401k custodian to split the assets. Many times this is 50-50, but sometimes it falls into a different percentage depending on the divorce agreement. When this gets split, if you're the receiving spouse, you get an account inside that 401k plan that's in your name. And this gives you a unique opportunity. Typically, if you take retirement assets and you're younger than age 59 and a half, you have to pay potentially taxes on it, but you more importantly have to pay a 10% penalty when you take retirement assets out before 59 and a half. However, if you're the recipient of a QRDO, you get a one-time exception where if you want to take cash out of that account, you can. It may still be taxable, depending on the tax treatment of the account that you're receiving, but you get to escape the 10% penalty. There's some requirements around it. There's some hoops you got to jump through, so make sure that you talk to a professional to make sure you get guided correctly through this process. But that 10% exception to the penalty could be a really key issue. But if once you transfer that QRDO money to an IRA, which many people want to do, you lose the opportunity to take that 10%. So make sure you do the planning up front before you start making any movements. If you're trying to split an IRA, there's a little different process. It's not technically the QRDO process, but there typically still is a divorce decree that has to be sent over to the custodian of the IRA. There's some forms that have to be filled out. You'll have to open up a new IRA or Roth IRA to be able to receive the funds. But there's a process that you have to go through to split those that typically goes pretty smoothly. The third type of account that you might have to split would just be a normal investment account. So not a retirement account, not something tied to that. And those actually split typically pretty easy. Again, you've got to get your own account, you've got to sign up for your own account, assets will transfer to those. Typically assets will transfer in kind, meaning shares of stock will actually transfer over. It won't always be just cash, shares of stock may transfer over. However, when you transfer stock over, that could have tax implications when you go to sell them later. So make sure that you work with your attorney, make sure that you work with your financial planner, whether you're giving assets or receiving assets, that you plan accordingly for what the cost basis is of those assets. And lastly, just really quick, it's important to reassess some of your financial plans as you're going through this divorce process. Make sure that you look at your estate plan. You'll probably need to update things like your will and trust and power of attorney. You'll have to update your beneficiary designations. We've seen this missed so often inside your 401k, IRA, and life insurance plans. You might have to update your savings rates to make sure that you stay on track to financial independence and that you have a strong financial foundation. And so these are just a few of the big topics that you're going to have to navigate. And so working with a financial planner like those at Straight Path Wealth Management that can guide you through that process will be really key. Good decision making during this difficult time can have a dramatic impact on your financial future, and it's worth working with a financial planner who can help walk you through that. We also have a guide that you can download that walks you through many of the things that we just talked about in a little bit more detail, helps you start thinking about these things and make sure that you make the right decisions.